All right. Good evening, everybody. My name is Joe Persichetti. I'm the Senior Director of Sales here at Henry Schein Financial Services. And on behalf of Henry Schein, I want to thank all of you for joining us tonight for part 2 of our year-end planning tax webinar series. This webinar is being recorded, and the link will be sent out to all the registered participants later on in this week. And as a reminder, this webinar does not qualify for CE credit. Tonight, it's my privilege to be joined by Bob Gray, CPA. Bob is a member of Gray, Pilgrim and Associates, LLC, and is one of the founding members of the Academy of Dental CPA. Tonight, Bob will focus on very important topics, employee retention tax credit, and other tax considerations as year-end rapidly approaches. We'll conclude tonight with a live session of Q&A. If you have questions that you would like Bob to cover, please submit them via the Q&A chat window, and we will address as many as we can at the end of the session. Lastly, in the chat, you will also find some more information around Henry Schein Financial Services and some of the things that are happening in Q4 around equipment and technology offers. With that, Bob, I will turn it over to you.
Thank you very much, Joe. I appreciate it. Welcome, everybody who's actually seen a prior webinar with me. Welcome back. For those of you who have not, let me start by doing the typical disclosure. We're going to be talking about tax tips tonight here, but talk to your own advisors to make sure you're implementing the ones that are right for you. For those of you who have not met me, I am Bob Gray. Very proud to be one of the founding members of the Academy of Dental CPAs. I think it's a very elite group of accountants who are all poised to really help dentists. I'm also an instructor at the Business of Dentistry courses that the ADCPA put on pre-pandemic. They were held in the Caribbean and in Hawaii, and so we hope to be able to bring those back, so stay tuned for that. I'm also an instructor at Henry Schein's Dental Business Institute, so I think that's why I got picked for tonight's topic. When I'm not doing that, however, my wife and I love chasing around Napa looking for those little boutique 100-point wines. Anybody who's never tried Bevan Cellars and likes a really wonderful Cabernet, seek that one out. And I'm also like to drive my wife calls the crazy car, the Cadillac CTS-V that was modified to a little over 900 horsepower. So it's a real adrenaline rush. I want to start out with a quick shout out to the ADCPA because a lot of people don't know really what that organization is. Again, all of the accountants in there aren't just accountants who happen to have dentists as clients. They're all knowledgeable about what the business of dentistry is really about and can be very consultative, not just tax preparers. And so we're all over the United States. I would encourage you to reach out and try to find one near you. If you go to adcpa.org, you'll be able to find a map, click on the map and find someone near you. People ask me all the time, though, Bob, aren't the tax laws all the same? Why do I need a specialist? But I would tell you that if your current accountant can't point to tooth number 8, you really want to find one that will, because if you have somebody that knows mesial from distal, they also know how to really help dentists and how to help draw out the actual tax deductions that you're going to be looking for. We're going to talk about a lot more of that tonight. Let me jump right into the employee retention credit. It's important because there were retroactive changes that go back to the beginning of 2021. But I still hear people that say, well, it's confusing to me and I don't know if I really, eligible for it, so I didn't apply. I want to go through a couple examples tonight so you can see how big this bonus depreciation really could be. I mean, it's a big deal. When they passed legislation on the PPP1 loans, and this ERC, we'll call it, Congress said, actually the SBA said you couldn't qualify for both. If you got the PPP loan, you couldn't qualify for the ERC. And Congress came back and said, well, no, that's not really what we intended. So they made a clarification retroactively in 2021 that applies to 2022. That retroactive makes it really confusing, right, for the people that didn't know what they were doing in 2020 anyway. But remember that on the PPP loan forgiveness, 60% of those expenses that apply for forgiveness had to be wages. The other 40% could be other expenses, rent, utilities, and the other things that qualify. Remember that it's really important as you're actually planning your PPP loan forgiveness, or if you need to edit anything from PPP1, to try to use those 40% of expenses to leave as much payroll behind so that you have it available to use for the ERC. That's going to help you. And we're going to go through a calculation here in just a minute. The eligibility requirements also were expanded a little bit. It said that you actually in 2019, as compared to 2021, for the first 2 quarters, your gross receipts, if they were less than 80% of the gross receipts in the same quarter in 2019, you automatically qualified. In 2020, it was a 50% drop test. So again, let's say that your second quarter of 2020, mid-pandemic, was 51% lower than the same quarter in 2019. Then again, you pass the safe harbor test, you automatically qualify. And if you automatically qualified in Q2 of 2020, you automatically qualified also in Q3 because the wage period does not end until the quarter after that is met. So again, if you were 50% down in the third quarter of 2020, now you'd be into the fourth quarter until you could actually, say I had to stop looking at wages. So I think it's a pretty big deal. Let me go jump into one of the examples here because I think it'll make sense. Remember, we're talking about qualified wages. So March 13th, which was the official beginning of the pandemic, so to speak, and the shutdown, this goes through all the way to June 30th of 2021. It not only is payroll, but it also includes healthcare costs that you pay for, not the employees. So you have to look and see if you qualify just by using that 80% test or the 50% test. The 50% test, it also includes, like I said, health insurance, but it was in 2020, it was up to a maximum of $5,000 credit per employee based on $10,000 of eligible wages. So it's 50% of wages with a max per employee of $5,000. The new law for 2021 raises that to 70% of wages with a maximum of $14,000 per employee or $7,000 per quarter. So it could be $14,000 for one employee in 2021. It could be $5,000 for the time period in 2020. I would say it's confusing because it was all retroactive, and IRS came back with guidance that said, well, if we're going to give you a credit on your payroll that you actually had in 2020, we want you to deduct this credit from what you take on your 2020 tax return. Well, there were already tax returns filed by then. There's a lot of confusion related to that, but I would tell you that even if you take it as income when it arrives, it's not exactly what the IRS had, but the overall effect is going to turn out to be the same. So many clients are saying, well, again, I'll post it as income when these credits come back. I'm not going to do it, retroactively or file amended tax returns to do that. Here's an example I wanted to point out. Let's just take a typical employer, someone who's got $300,000 a year in payroll. I picked a couple employees, maybe an associate made $100,000, then an 80, a 45, a hygienist, some office people, some chair side. So it might be a pretty typical, payroll. With that kind of payroll, that would have been eligible for a $62,000, $62,500 on a PPP-1 loan. Let's say they got that on May 1st. And they also got a PPP-2 loan, the same amount. If the employer uses none of their other expenses, no rent, no utilities, for PPP loan forgiveness, they use up all those wages. Under the original, CARES Act, your total ERC would be 0. After they did the retroactive change, look what happened. With those 5 employees, they were eligible for $25,000 in 2020. And 2 people hit it in the first quarter of 2021. And the other 3 people had to be reduced slightly because of you can't use payroll for both. You can't use it for PPP and ERC. So again, remember I said in the beginning, they used all the payroll for PPP loan forgiveness. There wasn't quite enough left, but they were still left with $77,500. I wanted to lead off with this tonight because I don't think people who haven't really looked into this realize this is a one doctor practice, maybe a slightly busy practice, but these are really big numbers that you could be eligible for if you actually did the application. Look what happens if we just had corrected that And instead of using all the wages for PPP loan forgiveness, we used 40% for things like rent, utilities, et cetera. You can see now that it went up to $84,500. The same practice, same example. It was just that they planned their PPP loan forgiveness better and didn't use as much payroll for PPP loan forgiveness. And so that gave them more money to use for the ERC, hence the fact it jumped up to $84,500. But look what happens if you get to a slightly bigger practice. Here's a doctor with 7 staff members. We can go through the numbers again, but look what happens at the bottom line. $120,000 of credit on the ERC. So this is a really big deal. I mean, for a lot of you who are suffering through the pandemic and cash flow, PPP loans were wonderful, but this is also out there and available. And again, you could get a PPP loan and still get this money. So there's no reason you have to worry about, the double dipping, so to speak. This money is out there, it's available, and you would apply for this by doing amended 941 forms. So the payroll tax reports that go in, there's an amended 941C that you would prepare and send in and apply for these refunds. You can actually apply some of the refunds to future quarters, or you can get the payroll tax dollars back. You can do it either way. And again, I want to go another quick example here. Remember that if you had 10 employees with an average of $4,000 a month, even just because of that month of May, remember that you received your PPP loan on May 1st, but instead of using those dollars right at May 1st for the PPP loan forgiveness, you used it for the ERC. That would give you a $20,000 credit eligible for that, just because, again, you planned your PPP loan forgiveness differently. And the ERC takes priority. In other words, the IRS said that it's okay. If I got my PPP-1 loan on May 1st of 2020 in this example, I don't have to start my wage period right then. I have 24 weeks, but I could go back to, say, June 1st and use up my ERC first, and then start my wages that are eligible for PPP loan forgiveness on June 1st and go out until I used up enough of those to qualify. So ERC does take priority in this particular example. So, what am I going to do when I am off of this seminar tonight? First of all, go back and look at the dates that you were under a mandatory shutdown. There are a few states that had a March 11th. There were some people that did mandatory things later, could have been March 20th. But look at what it was in your particular state, because the minute you were required to shut down, you're automatically eligible for the ERC. And then look at wages for those quarters. Look at the ones and see if there's a safe harbor where you were actually impacted by 50% in a quarter. If your office was shut down by a mandatory shutdown, and some states were almost into the month of May, even just that time period from March 13th to the end of April could be considered your ERC qualifying period. And so look at the wages, because again, it's 50% of the wages that you paid during that time period, up to $5,000. So determine which quarters you had a drop. Look and see now in 2021, when you actually recovered, or when you first recovered to 80%. Again, that's going to be the cutoff point where you're no longer eligible. And in 2021, remember, again, it was an 80% drop in revenue, or 20% drop in revenue, not a 50% drop in revenue. And again, I always say at the end, be sure to balance your calculations so that you maximize your benefits. Take what you need for ERC first. Take what's left for PPP. You want to actually lower the ERC if you have to use more wages for PPP. Because that, one's dollar for dollar, the other's 50% or 70%. So you don't want to, you want to maximize your PPP loan forgiveness first and use this for the ERC, but make sure that you're doing the balancing act so that you maximized your benefit under this plan. Again, I want to lead with this tonight because I think that this is a really big deal. There's a lot of people that have not applied for this. There was some of the stats I've seen from, that have been published is that it's a third of the eligible people have actually applied. So if you have any questions, check with your accountant. There's a lot of things available online. There's other resources out there, but make sure that you get the money that you actually deserve under this program. I want to flip over and start to talk about some of the tax planning tips. And for those of you who were on a previous webinar with me, a few of these are going to be repeated, but I have some new things that I wanted to bring up and some things that we wanted to talk about before year end comes crashing in here. One of the things is the interest on your PPP loan. Let's say that you got a $100,000 PPP loan on May 1 of 2020. The loan, you applied immediately for forgiveness, and it was forgiven in Q4 of 2020. That'd be pretty early, but most people would be in 2021. But let's just follow. Everyone knows that the loan forgiveness is not taxable income now. That's fine. What they forget, though, is that let's say I had $2,000 or $3,000 of interest. When you got your PPP loan forgiven, they not only forgave the $100,000, they forgave the interest that accrued on that loan during that time period. And the interest that they forgave, I'm taking the position is still tax deductible. There's some other authors out there and people that say, questionable. The IRS has not said yes. But remember, the IRS came out and said yes for certain. SBA gave you $100,000, wasn't your money. And you were allowed to tax deduct all the payroll that you spent with that money, even though it wasn't your money. And so I think the interest is exactly the same. You could have tax deducted this interest as a business loan. They paid it for you, but that didn't make it not tax deductible because all of the proceeds of the money from the PPP loan, as long as they were used on qualified expenses, are tax deductible, but not taxable income on the loan. So again, pick up that extra interest as a deduction on your return. You might have to file some amended returns, but again, many of you were actually had loan forgiveness in 2021. And so that may not be an issue. One other topic I want to talk about is maximizing itemized deductions. Back in 2018, Trump changed the rules and we significantly increased the itemized deductions, the standard deduction amount. So in 2021, a joint couple would get $25,000 of $100 of deductions, even if they didn't spend any of it. In other words, they could have zero mortgage. They could have zero taxes, if that's possible. They could have no charitable contributions, and they would still get $25,100. So look at this example where I said, if you're planning on making charitable contributions, so if I did even gifting, where I do $3,000 per year, you see that line on charitable contributions? Because I pay taxes that are limited to $10,000 under the new rules, and I have $12,000 in mortgage interest, I only have $25,000 of actual expenses. So I'm just going to get the $25,100 of standard deduction. And then if I do it again the next year and the next year and the next year, I never qualify. Consider the possibility of saying, well, listen, I was going to give $3,000 to my favorite charity this year, and I was going to do the same thing again in 2022 anyway. What if you actually gave $6,000 all at once in December to that same charity or charities? Look what happens. Because you actually now got over the itemized deductions, standard deductions limit, you pick up an extra $1,160 of tax savings, even though you spent the same amount of contributions. It was just a question of the timing. So before you make gifts, look and see whether it's going to be applicable for you to consider lumping them into 1 year. It could definitely help your itemized deductions. The other thing I want to talk about is a qualified business income deduction. Same thing. This was created in 2018 with some major changes that Trump put in place. But the qualified business income deduction is strictly for what they call entrepreneurs and business owners. It is not for W-2 employees. So the problem is that all of you doctors who should have been and were rightly S corporations for all those years gone by now kind of wish that you weren't. For many cases, if your income's under $400,000 a year, because your W-2 is not considered income that qualifies for this QBI. It's only the K-1 income that you get from your partnership, from your S corp, or from the actual Schedule C if you're a sole proprietor. But you're required to take a reasonable salary out of your S corp. So you can't just stop taking wages. But you can still plan to maximize it. Right? You would still try to say, well, what's the minimum reasonable salary that I'm going to take so that I can maximize my K-1 income and maximize my QBI deduction. Again, it's a 20% deduction of income. So if I were, let's just say, a solo associate with their own private LLC as an independent contractor, and I made $100,000 last year, I only pay taxes on 80 of it. I get to just ignore $20,000. So again, it's a pretty big deduction. You want to make sure that you maximize that as well. One of my favorite topics is also children on payroll. I know there's been some articles written back and forth about this, but there were a couple court cases where people won against the IRS talking about use of photos, use of children in commercials, use of things like that. I would still argue that the Screen Actors Guild and the union sets the value of a photograph. They use the value of a video. They have a value of a performance. If the union sets it, then it's very difficult to argue that's not the fair market value. And if they set $712 as an individual single-use photo and with a 300% charge for the unlimited annual use, that makes every image worth about $2,136. So many of you already have pictures of kids on website. An example right there on the screen of a doctor I took off the website. No idea who that is. But at the end of the day, those children could easily be compensated. Even if it's the same photo, all of them could have been compensated. And if there's 3 different photos, that gives you the opportunity to pay them $6,000 a year. And $6,000 a year for a child is not taxable income. It's zero federal. But the parents are taking a $6,000 tax deduction in their higher bracket. The magic of all this, though, is if you started early enough, let's just say that you really did start, at age 1, and you were able to pay out to age 20. Because you're taking a tax deduction, your only real cost is about $3,600 a year for the parent. If you only made those contributions and then quit, you never made another contribution after age 20, that at 5% would grow to be $1.9 million with the magic of compounding. So what an incredible gift you could give, your child. But even if the money is just for college, there'd be about $168,000 in that by age 18 with 5% growth. And the child still has 3 more years of college. You can take a $6,000 W-2 for to help pay for that. So again, letting the practice pay for the college education is a lot more affordable than taking it out of what I call hip national bank, where you're just digging out of your wallet to pay for college, right? I want to point out, though, that if you have children working in your practice and they really are doing other services, $12,000 for 2021 is the amount they could earn completely tax-free. And again, the practice owner as the parent would be tax deducting that. So it's pretty beneficial. So keep that in mind and, put the little beggars to work. Let me talk a little bit about dental equipment. I don't think a lot of doctors realize, the new toys are fun, but I don't think a lot of people realize how dramatic the difference is when you buy new equipment. Let me talk about Section 179 and the bonus depreciation deduction first, because these are all can be very confusing. Section 179 is set at a limit of $1,050,000 as long as you spend no more than $2.62 million in equipment for 2021. Again, for most of you, that might not be a problem, only spending under 2.6. And 179 is the section of the IRS code that just says, even though I bought it and it's supposed to be depreciated, I can elect to just say, hey, I'm going to take it all as a tax deduction this year. Later, Congress came out with what they call bonus depreciation. And bonus depreciation has changed much wildly over the years throughout all these tax law changes. But right now, bonus depreciation, and even through 2022, is unlimited. Again, unlimited 100% write-off. So there's not a $2.6 million purchase limit. There's not a $1.05 million limit. It's whatever you bought, you can elect bonus depreciation on. So the question is, people say, why would I want one versus the other? The problem is the states treat these rules differently. These are the IRS rules. And so if you live in a state that says, we don't recognize bonus depreciation, but we do recognize Section 179, then make sure you elect the one for your state that actually matches what you're trying to, maximize and what you want to do. For those of you who live in states that actually follow the IRS guidelines, bonus depreciation can be a very powerful tool. And, it's 100%, can be 100% tax deductible. So keep that in mind. The other question always pops up as well. You have to place this equipment in a service in 2021. It can't just be paid for. It's got to actually be plugged in before midnight on the 12/31. So just having an invoice is not sufficient. And I know that a lot of people in equipment sales hate to hear this, but now let me say, and I'll say this with one eye closed, is that anybody here see this 55 speed limit down there? Anybody listening to this who may have gone 56 miles an hour in a 55 zone before? The thing is that this rule is violated all the time. I'm telling you on this page what the correct answer is. Now I have to tell you that I do constantly see this rule, being violated. And here's the problem. It's a kind of a victimless crime, if you know what I mean. If I took a deduction in 2021 for equipment that got delivered on the 3rd of January, I was going to either take a deduction this year or I was going to take it next year anyway, right? I'm not taking anything unfairly. It's just a question of when it applied to. The other thing is that under audit, what's the IRS going to do? They're going to ask to see the canceled check and they're going to ask to see the invoice. They're not looking for shipping documents. They're not looking for things like that. And so the reality is, you be your own guide and let your conscience be your guide. But I would tell you that you would be in good company, and a lot of people, might bend this rule a little bit. It must be paid for and it must be invoiced, but placed in service and actually plugged in is the official rule. Let me talk about a real live example here so you can see what we're talking about, though. This is this was actually a Celea laser that one of the clients was contemplating purchasing and asked about the cash flow. So I use this as an example because it's pretty dramatic, I think. I know that Shine and several other lenders have opportunities for 6 months of no interest. I'm sorry, no payments on a loan. So I took that as a great example. If you looked at the actual example that's up on the board here, you'll see that we purchased $150,000 of equipment on, then it was just say it was on November the 1st. There would be 0 loan payments required during that time period. And so there'd be nothing that would be due at all from a cash flow perspective. But there'd be $45,000 in tax savings for the client that we do. That was state and federal. However, what that also does is remember that estimated tax payments can be based on the prior year. So if I lower my tax liability in 2021 by $45,000, I also get to reduce my estimated tax payments for 2022 by $10,000 a quarter. So if we just go out to that first quarter in 2022, I bought a piece of equipment, I've made no payments on it whatsoever, and I have $55,000 more in the bank than I had the day that I signed the paper. That's a pretty dramatic cash flow effect. And I think this is pretty typical. Again, this is not the very highest tax bracket. I think these are pretty typical taxpayers that would be seeing this. And I'll show you a QBI example as well coming up here and how that interplays. But again, pretty good ROI. The other thing it gives you is that, if you're looking at maybe at CAD CAM or other technologies that they're having a learning curve on, if I have $55,000 in extra cash, I'm not quite as worried about, a few days of production that might not have been as stellar as they were before because I was going more slowly, trying to learn about this new technology. Again, you've got a way to fend off that cash flow crunch. Remember, but again, people forget the 2022 effect of that. Again, if your AGI is more than 150,000, you're required to pay 110% of the tax you paid last year in equal 4-quarter elements or on your W-2. And then there's no penalty. That's the safe harbor. You could have hit the lottery and owe $5 million on April 15th of the following year, but there's no penalty. So again, by lowering your tax liability for 2021, you also lower the amount you had to pay by statute during 2022. So if again, I'm using that 110%. Let's say you lowered your tax liability by about another $40,000. Not the liability, the requirement to pay. Now we're talking about April 15th of 2023, when I have to actually give back that $40,000 if my income was as high that year. But I would say to any of you listening, if I said to you, hey, I'm going to give you $40,000 right now, you come back about a year from now and give me back $40,000, no interest, no other costs. That's a pretty sweet deal from a cash flow perspective. So I think that the subsequent payments and these tax payments for 2022 are an important consideration when you're looking at, expansion, equipment purchases, that sort of thing. Keep that in mind. The other thing I wanted to point out was what the difference was. Oops, went backwards. I want to point out that this was a LLC. But this applies to everybody. I hear people say, "Well, I'm a C corp. I can't really benefit by some of these equipment purchases." And I would say, well, yes, you can. Especially even now, to many of the doctors who are C corps who take big bonuses at the end of the year, they take a base salary through the year and take a bonus. You could lower that bonus significantly by buying equipment or doing your expansion this year. So, it requires a little bit more planning in a C corp, but it does apply to everyone. So don't assume that, you're exempt, because you are definitely not. Anyone who purchases can get these kind of benefits. Here's the QBI example I wanted to show you, because this was a real live, again, kind of example. I rounded the numbers here. But let's just say in that center column, well, let me talk about the limits again. The QBI phases out for professionals. If you're, a dentist, you can only earn $429,800 of taxable income before this thing phases out to zero. I hope everyone in the room or in the webinar here is over that limit. Maybe some of you are not. But here's an example. Let's say we took a doctor who was. So look at the center column here that says without section 179. Let's say you had a practice net income of $470,000. And you had $30,000 of adjustments or write-off, tax deductions. So your taxable income was $440,000. In that example, your QBI deduction was zero because you were over the $429,800 limit. But now let's say I bought that laser or that equipment, and I bought $150,000 worth of, in the same example. Now my taxable income with section 179 drops to, or the practice income drops to 320. I still have my itemized deductions, but now I get a $64,000 QBI deduction, not just a $150,000 deduction. I get $150,000 for the equipment and a $64,000 QBI deduction. That is a really big deal, because now when you look at the tax effect of that, there was and this is again, a person at $470,000 or $220,000 of taxable income. You're not in the highest bracket, but it was a 41% federal tax savings, and that's federal only, because you managed to coordinate it so you got yourself into that QBI limit and under that limit so that you could take the QBI deduction. So when you're looking at this, some of these equipment purchases at year end here, again, it can be a really big deal, because that's a lot of tax money to save in the first year here. Another topic I talk about a lot in seminars and things is how to turn studs and drywall into section 179. I do seminars and I ask dentists all the time, has anybody here ever heard of a cost segregation study? And what is it? And rarely do any hands go up, which is sad, because when you're doing expansion, when you're building buildings, and you're doing things like that, this can be a tremendous, tremendous tax deduction. The IRS says that if a building, and I'm going to use $1 million building in this example, $1 million building has to be depreciated evenly over 39 years. And it's actually 40 because it's a half a year the first year, a half a year the second. But call it 40 years. It's about $25,000 a year for 40 years. It would take you if you had $1 million building. If you do a cost segregation study, the lowest amount that I've ever seen that winds up in the 5-year category is about 20% of the cost of the building. And let me go back and explain that again. So by say the 5-year category, this whole cost segregation study thing started when the Hospital Corporation of America actually just defied the IRS's rules about this 39-year depreciation. And they said, heck, look at this carpeting, this flooring, these ceiling tiles. They're not going to be here 40 years from now. We're going to depreciate them over their real useful life. The IRS fought them and they lost. The court said, well, that's ridiculous. Why would you depreciate carpeting over 39 years? So hence cost segregation was born, where you break a building down into its pieces. The really important thing, though, is that when you break a building down into its pieces, if I have things that are equipment related, let's say I had a built-in desk at my front waiting area. Let's say I had built-in, anything that would have been furniture related. Let's say I have a non-load-bearing wall between operatories that is really only for patient sound barrier. It's not a building. What if I have plumbing under the floor that goes to dental equipment? Now that's dental equipment. And remember, everything that you turn into 5-year property like that, which is dental equipment, is subject to Section 179 and bonus depreciation. So on the left example, I have none of that. In the right example, where 20% of it was eligible for 5-year write-off, I could take a $200,000 tax deduction. And even for the stuff that's in the 7-year, $210,000 tax deduction immediately. And let me tell you again, this is being very conservative. These are conservative estimates. And when did you need the tax savings the most, right? It's when you just built $1 million building, you've got a big mortgage and a lump in your throat. So it's important to consider this option. When we send these little reviews out, they'll send back this sort of sample analysis of exactly how much of it would be in those various categories, the 5, 7, 15, and 39 year. Again, I used a conservative example here. But I want to point out that this is if you owned $1 million building. But the same thing applies if you did, let's say, $500,000 in tenant improvements. You don't have to own the building. If you do the tenant improvements and you pay for them out of your pocket, you are still eligible to do this sort of analysis and get these kind of rapid depreciation. And again, who wants to wait 39 years to get the tax write-offs for all the improvements they've made or the building they've built? I need to show you a quick example. When I ask people, well, what is that? You'd say, well, I think it's an electrical outlet. Well, no, it's not, because it depends what's plugged into it. If a fax machine was plugged into that, then that outlet is a fax machine. And not only the outlet, it's all the wiring and all the way back to the breaker, or even part of the building permit, to get is allocated. It turns out to be like a $380 item that is immediately tax deductible, used to be 39 years. Another quick example, this is just a wall sconce. And because it's just decorative lighting and not considered essential lighting, it's immediately tax deductible in the year the building was built. And again, all the wiring, all the plumbing, all the infrastructure, all that stuff winds up to be dental equipment, which is huge. What doesn't qualify is any load-bearing wall or the roof, and land never qualifies. So just remember, we're talking about building costs only that apply for that. But again, I think this is a huge deduction and comes at a time that you could really, really use it. So I think it's important to make certain that you at least understand the concept of cost segregation and are talking to your accountant about that when these expansion projects come up, and know that it's available to you. The other thing you can do is the question of timing on these studies. Let's say I built $1 million building, but I bought a whole lot of new equipment, so I don't really need a write-off that year. Why do I want to do a cost segregation study and just pile on? It doesn't help me to get my income down to zero, right? Well, you can actually wait on these studies and do something. Let's say you went out to year 2 or year 3. The rules say that you can go back and take all the depreciation you could have taken in that 3-year period, all in year 3. So maybe now the practice is really zooming. and you used up all your equipment, deductions immediately, that'd be a great time to do it. Because I always tell people, remember, if you pay no tax one year, you've wasted some deductions, right? Taxes are on sale and they're only 12%. And you can see that 12% bracket for, married folks goes up to $81,000. I'm not sure that if I used my tax deductions to get my $81,000 income down to zero, I only saved 12% of that $81,000. I'm not sure that was a really good use of that tax deduction. I'd rather save those deductions and take them against income when I'm in the 30% bracket, the 35. Who knows when Biden gets done if we're going to have a 40% tax bracket. So again, do not zero out your taxable income. You're wasting money if you do that. The other thing I want to talk about tonight is just, debt consolidation. With interest rates at such an all-time low, I think a lot of doctors just got caught in a rut of just continuing to pay the loan. I think here's a quick example here. So we have a dentist that had two different kinds of loans. One was maybe the initial practice startup loan for $300,000. 3 years later, they added a couple more operatories, and now they had another $100,000 in loans, and they're making $6,200 a month payments to the bank. Well, and this was, I threw back in, add a laser or add a CAD cam, add anything else you want to here. Look what happens if you say, I'm going to pay off the initial practice startup loan, pay off that second loan that started 3 years later, throw in a purchase of some equipment, and then refinance at some of these rates. Again, I know that Shine had a 4.49 for 5 or 7 years up there. Even on a 5-year payment, look what happens. My new payment's only $4,677. I was paying $6,200 before. And I think a lot of doctors, it's just easy. You take out a loan, you put it on auto pay, you don't really think about it. You kind of forget about the interest rate. And, you're looking, but if you're looking at new technology or even just a refinance, I would tell you there's some really incredible deals out there right now. And so make certain that you're looking at your loans and the interest rates that you've got and talk about whether this is a great time to refinance or not, because it could be a significant cash flow savings for you. One of the other things that I see all the time when we're doing reviews is that people have the wrong pension plan. You can start out with what they call the simple IRA plan, where the maximum contribution, voluntary contribution, is $13,500, $16,500 if you're age 50 or over, and then a 3% match. That's great because it has no costs. It's literally zero fees. It's only whatever the investment firms charge. There's a simple one-page form that you sign when you apply for this. So it's a very, very straightforward thing. Each of the participants then has their own IRA account they contribute to. Very, very simple. Again, it's pretty easy. The problem is it's limited to $13,500. So what typically happens is a lot of doctors go up to the 401k plan. The 401k plan has a $58,000 maximum voluntary contribution, including the practice portion. So again, that fits a lot of doctors. That's great. What people forget about, though, is that there are things called defined benefit plans. We call them also cash balance plans, which is a different type of defined benefit. They have a maximum contribution of $230,000. Let me say that again, $230,000. If you're a doctor later in a career, or you've got some significant income, and you are saying, well, gosh, maybe I don't have all the money invested in right now for my pension savings that I'd like to have, and I do have $200,000 I could put in here, maybe this is the right time to consider that. By putting a combination plan together, a 401k and this defined benefit or cash balance, you still have a $230,000 max, but you can really cut back on the employee costs of running the plan. Let me share a really quick example here. This was an oral surgery practice that had one associate, 2 owner doctors. If you just look at that number in purple there, the 2 doctors that are the owners split $322,000. The staff cost was $32,000. So the practice took a tax deduction for $355,000 in this example. The doctors got $322,000 of it. I would argue for any of you higher earners, that's a pretty good deal. It's a simple thing to find out. You would just give your employees census up to any of the pension planning firms that do these plans. They would be able to come back and tell you exactly whether this is the kind of thing you might be able to enjoy, or how much you would be able to contribute as the maximum that year. And then again, what the employee cost would be. If you have a lot of older employees, it might not be right for you. But gosh, a doctor with younger employees, these things can really, really be beneficial. So again, just make sure that you've got the ability, to compare and make certain you've asked yourself, do I have the right pension plan? Here's just another small thing that I see missed. If there's any recent graduates listening tonight who have their own LLCs and they are independent contractors, when you bought your dental books, articulator, hand instruments, all that sort of thing, all of that stuff was purchased as, educational equipment. It was not tax deductible. The thing is that when you then converted it to business use, and it only has to be available for use, it doesn't have to actually be used, right? It has to just be in the building and available for you to use. You converted it to business use, and that makes it all tax deductible. So I would encourage you to go back and look at, your dental library, the reference books that you brought with you, articulators, anything at all like that. Again, it's the value on the day that it was converted. So it's the used value that you can now take as a tax deduction because you converted it from educational to business use. Something else I see missed quite often is that a lot of dentists don't know that you can actually tax deduct the cost of specialty training. If I'm a general dentist, I wind up with my degree and I go straight on into, let's say, an ortho program. I cannot tax deduct the tuition for becoming an orthodontist. However, if I went out and started in my own LLC that summer, had, started my business, had income from seeing patients or from being an associate at other, practices, and then decided to go on to be an orthodontist or any other specialist, now the tuition is considered continuing education and is tax deductible. What an enormous tax deduction. I talked to so many specialists who are now right out of the program. And they go, oh, I had no idea. Wow. I wish I'd, talked to you 4 years ago. I would have worked for 6 months before I went into, my specialty training program. But again, for any of you who are, considering going back to that specialty training, make sure you've got general dental business income, not a W-2, before you do it. And then you qualify. So don't miss that opportunity. One of the other things that I think is cute, if anybody ever seen that extreme makeover home edition where they tear down people's houses and fix them all up, and they're always in a big hurry. I always wondered why. And then I went back and realized that if you recall when the Olympics were in Atlanta in 1976, America was embarrassed because we didn't build enough hotel rooms fast enough. So Congress came up with this thing that said, listen, if you rent your house out for that 14-day window surrounding the Olympics, we'll let you keep the interest or all the rental income, and it's not taxable. It's completely tax-free. Well, they never took that rule off the books. It's just always been there. And so now if you go back to that extreme makeover home edition, I realize why they're in such a big hurry. They only had 14 days because what they do is they rent the homeowner's home, tear it down, fix it up, which again, because I'm a renter, any improvements I make to your house while I'm renting it, you get to keep. It's not your fault that I made those improvements. And they get to keep all the personal property that's left behind, the couches and the appliances and things, that's the rent. And so they wind up with this tax-free ability to get these extreme home makeover. Now, again, I would say that that's the extreme example. But, if you're going to have business meetings at your home, and maybe it's just management. Maybe you just have a hygiene manager and a front desk manager. Maybe it's the entire staff. Go to your local country club, go to your local banquet hall and ask them what the cost would be to rent the facility for a day. Use that as your fair market basis and then rent your house to your practice for that same purpose, for that meeting. You can only do it 14 days or less. But, the rent, if the fair market rent that you pay yourself would be completely tax-free income to you, and tax deductible to the practice. So again, could be a sweet deal. I also want to talk about family limited partnerships, the FLPs. An FLP is a strange partnership because all of the people that are inside are family members. By the rules of attribution, they're all considered one. The rules of attribution just combine, say that you can your family members are all considered related to you for tax purposes. What that means, though, is that I could put my building in a family limited partnership. I could own 99% of the building and gift away maybe just 1% to my children. And the only one who makes decisions. I'm the only one who gets to say what goes on. However, I could actually what they call anoint other younger family members with all of the income from the K-1. Now, again, with kiddie tax and things you have to pay, but if you've got some 20-year-old, some children in their 20s, this is a great income shifting tool where they're going to actually pay the income tax on the rent or the profit from the rent of the building. The other great thing is that you can actually gift away $15,000 a year, gift tax free to any particular recipient. So if you're married, you and your spouse could each give one child $15,000 or $30,000, and you could call it $30,000 of the building. Now, again, if you do this year after year over time, you can see what happens is the children now own the building. So it's not part of your inheritance or not part of your estate for either federal or state inheritance tax, which could be a really big deal. But again, you could now be reversed. You could be a 1% owner as years have gone on with all the children. But you're still the one general partner who makes all the decisions. And so you don't have to worry about the kids interfering with the building. Again, a great tax planning tool for those who own their own building. I had to do a quick shout out just because, we've all been reading the news. I would tell you that I don't, the dysfunctional Democrats are not getting anything done currently, but stay tuned to that channel because I would tell you that what they really want to do is significantly reduce the current estate tax exemption. So if you're a high net worth doctor listening tonight, you really, really want to double consider the possibility of some of those grantor trusts and, some gifting during your lifetime now to use up some of that exemption, because I don't think that we're certainly not talking about increasing it on the horizon. Let's put it that way. So, right before year end, you might want to certainly consider that and talk to your estate planning gurus about, what's right for you. The other thing is that the HHS, if you haven't already heard, brought out a fourth phase of grant money. This grant money is for, again, the last round, what they say is the last round potentially of this money, but it's $25.5 billion that's floating out there. They've earmarked $8.5 billion for the rural Medicaid and the CHIP programs, but they have $17 billion for general provider relief. If you look at your practice financials and you have not, quote, recovered from the pandemic in that the prior grants and the other monies that you got from either state or federal funding did not put back all of the income you lost and pay for all of your COVID-related expenses, then you're eligible to apply for more money under grant on this program for four. The applications just opened recently on the 29th. I think they're going to close by the end of October. They may leave it open, but if you're potentially still, have economic harm from the whole pandemic, consider applying for this grant. I think that, the worst thing they could say is no, or they run out of money. But, I would take all the grant money I can get to fix the problem that the pandemic has created. For tonight, and again, let me just do a quick review. I think you just want to go away tonight saying, well, should I actually check? I need to check and see if I'm eligible for the ERC. That's the one big thing, is we're talking about significant amounts of money. Remember, those credits were, between $50,000 and maybe $100,000 just for a solo doctor in a lot of cases. I would say tax planning is complicated. It doesn't help to wait till April 15th and talk to your accountant and say, well, now what should we have done for last year? You want to be very proactive and take the stands to make the changes now before December 31st. Again, I'm not in the business of selling equipment, but I would just tell you that when the income tax effect of lowering your income this year based on some expansion or some other purchases is really significant. So if you're considering it, if it's right for you, if this is a good time, again, talk to your accountant about that as well. I want to throw in there, don't forget to apply for PPP loan forgiveness. October 30th is the final cutoff for anybody who got a PPP-1 loan, because that's the final cutoff date plus the 24 weeks that would have been applied for that, plus the 10 months. So you want to make sure that you didn't fall asleep and forget to apply for loan forgiveness. I would also say, remember, choose wisely before automatically taking bonus depreciation. Remember that slide that said taxes are on sale when they're 12%? Don't be one of those doctors who goes, woohoo, I paid zero income taxes for 2021 because I bought a lot of equipment. That wasn't the right thing to do. You might want to elect out of bonus depreciation for some of those purchases, or elect out of Section 179 to get your income up to that sweet spot where you're just paying 10 or 12% in taxes. So that can be good. And again, you remember, you can turn studs and drywall into equipment. So just remember the word cost segregation study if you're doing any major expansion, new building purchases, fit outs of a rented space. Talk to your accountant about whether or not that's something that would be right for you. I always promise at the end of all these things to do live questions. So I think we've left a few minutes at the end. I'll stick around here a little later. I know I ran over a little. I had a lot to cover tonight. So, Joe, do we have any questions that have come up so far?
Yeah, we sure do, Bob. And first off, I just want to say thank you. That was a lot of content, and I'm sure that everybody got a lot out of it. So we'll start with one that I can answer. How do we get the recording of this webinar? So we will send out a link. Anybody that registered will get the email link to them by the end of this week or early next week. So look out for your emails, and you will get a copy of that recording that will come your way. The next question, Bob, was, are practices that opened in 2020, if they just opened in 2020, eligible for ERC?
They can be, because what happens is if you did, your numbers are based on your predecessor's actual financials. So you would get your predecessor, the selling doctor's financial information from 2019, and you would use that to compare to see, let's say you bought the practice 1/1 of 20, just to make it simple. You would look at your, say, Q2 of 2020 and compare it to the selling doctor's Q2 of 2019. That would become the basis for your eligibility for the ERC.
Awesome. Thanks, Bob. And this one kind of ties to that. I'm sure I think I know the answer, but in case, do we qualify, so similar situation, but for 2021, do we qualify for ERC for third and fourth quarter as a recovery startup business? We just purchased a practice in 2021. My corporation is brand new, but the business is existing.
So again, remember that the cutoff was June 30th of 2021 for this year's ERC. So you had to buy it before June 30th. But if you did it's the same answer. If I purchased it in Q2, I would look back to Q2 of my predecessor, my selling doctor's numbers, and use those for eligibility.
Awesome. Thanks, Bob.
Mm-hmm.
All right. The next one up, my PPP loan was already forgiven. I met the requirements in its entirety with payroll. How does this affect the numbers with the ERC? I cannot go back and change my forgiveness application.
Yeah, there's some arguments about whether you can or cannot change those applications. If the numbers that were on the applications could have been changed, because remember, ERC is by default the payroll dollars that would go first. Congress said that very clearly. And so if you made a mistake on your original application and you could have used ERC first, but you still had enough payroll in that 24-week period to wipe out the PPP loan, then I'm arguing that it was a simple oversight. It could be corrected under audit. If you came back for the SBA, would have enough payroll in that 24-week period. It just wouldn't be the payroll that starts on day one of your PPP loan, like you originally said it would. But you have enough qualifying expenses to actually, qualify under audit. I really doubt that the SBA, because you misunderstood the actual way in which you were supposed to order those wages, is going to come back and to say on a technicality now that we want the money back. If you really qualified, you qualify. So I'm arguing that you can amend by calculation those PPP loan forgiveness applications.
And then very similar, just extending off of that, another person's question. I've already applied for and received my PPP loan forgiveness. So the application is done and has been forgiven. I claimed 100% of the loan was attributed to payroll. Does this mean that there is no way for me to claim this credit?
Well, again, so the answer is no. I mean, even if you went backwards, even if you said, well, listen, I am going to ignore the payroll that I used for PPP. Remember that there's a lot more payroll. That was only you got about 12 weeks of payroll in your PPP loan. There's 52 weeks in the year that could have been, payroll eligible for the ERC. So it doesn't mean that you're ineligible. It only means that if you're going to be straightforward and never use those same dollars, those exact same dollars again, you could still apply for ERC. It'll probably just be a reduced amount. But again, remember that Congress said that the ERC trumps the PPP loan. So technically, when you use those dollars, if you were eligible for ERC, you just made a clerical mistake. And if you still have enough to cover, I think you'd be fine with the PPP loan forgiveness.
Awesome. Thanks, Bob. All right, a couple more. We have time for a few more questions. So the next one is, are there any different rules? What are the rules for gifting my son? He is 21 years old.
Yeah, there's no age limit on a gift. You could be 6 months old or 106, and you still, if I have, let's say, $11 million in my lifetime exemption to use up, I can give $11 million to anybody that I want to. And for the annual exclusion of the $15,000, I can do that to any number of people. One person can give an unlimited number of donees $15,000. So again, depending on how big your family is and how many people you're trying to benefit, make sure you're using that exclusion if you're a high net worth doctor.
Awesome. All right. The next one is, are the employer's portions of SSI and Medicare included in calculating the wages for ERC credits?
No. It's only the actual gross wages.
Awesome. Okay. Thank you, Bob. And then we have a couple questions around the 941. So maybe a twofold question here, Bob, from a couple different people combined. One, how long are the 941 amended returns taking? And then with that, what other forms do I need? Can I fill out these forms without an accountant?
Again, if you look at the 941, it's actually pretty straightforward. So you could give it a try without the accountant. But I would tell you that the IRS is so far behind in refunds, it's not even funny. It's embarrassing how far behind they are. We've had clients that we're still waiting for 2019 income tax refunds. That's pretty sad. And, some of them are getting letters that say, hey, sorry, we're still under review, or we're doing this or doing that. But some of the refunds are just really delayed. And we've had a number of people that applied right on the, early on for the ERC credits. And I'm going to say now we're 6-7 months into these applications, and very few of them have seen the refunds yet. It's going to take the IRS a really long time, because most of these are all paper filed. And, there's not enough staff to do this. But, I'd rather have the money eventually than to not have it at all.
Absolutely. And if the next question, and we'll do two more. So if the next question is, if most of your employees were on unemployment while you were waiting for your PPP loan, are you still eligible for the ERC? Only 2 of my employees were on payroll part-time at that time.
Well, yeah, then only the 2 people you were paying are the wages that you would be using for ERC. But remember, there's a lot of doctors that let employees use up unpaid sick time or vacation time or other things during the pandemic in order to keep their cash flow up. And so regardless of whether it was sick pay or vacation pay that you paid during that shutdown period, it still qualifies as wages.
And then last one, for a sole proprietor, rules for whether a non-dental spouse's W-2 salary can be included in ERC payroll.
It cannot. So that's the only, for an S corporation, it cannot.
Awesome. All right. Well, Bob, I'll let you close it out, but I just want to thank you again for joining us tonight and spending this time this evening, as well as all of our attendees for spending this time with Henry Schein and Bob Gray. It was great content tonight, a lot of questions, and thanks again.
All right. Thank you, Joe.